Coming up on Retirement Today with April Roberts.
It sounds fabulous, doesn't it? Okay. But what are the Lipper Analyticals? Lipper Analyticals are people in your mutual fund's peer group, like they're all in growth stocks or they're all in mid-cap. That just means they beat 92% of the other funds.
That's why we want to set up your income from the foundation. We'll take our fund money from the walls, because your walls might get crooked and need some patching, but they're not really going to fall down unless the storm's really bad. And then we'll leave the rest in the roof. But when you look at the historic numbers, it says that it was down 38% in 2008, and that's all anyone talks about. It's not the full story just because it was December 31st.
And now the host of Retirement Today, April Roberts.
Hello, and thanks for joining us today. Don't go anywhere, because Retirement Today starts right here, right now.
Hi, and welcome to Retirement Roundtable, where we're doing part 2 of a 2-part series, Mutual Funds, the Good, the Bad, and the Fine Print. Guys, last time we talked about so many things, but I'm going to start it out right now with you, April, and we're going to talk about the loss of a talented manager. Now, I don't think people really think about this in their mutual funds, but the person managing that mutual fund, they might be out the door.
Absolutely. So I always say, if you have a mutual fund you like, if they change managers, you probably should get rid of the mutual fund. And what most people don't realize is you can go easy places like Yahoo Finance, look up the details of your mutual fund. It'll tell you who the manager is and how long they've been there. For example, let's say you have a mutual fund that you think has a great track record going back to 2000, right? Because we should look at a 10+ year track record. But then you look at the manager and he's only been there for 2 years. Well, first of all, I want to see how a manager did in 2008. I don't know about you.
Right.
And second, if he's only been there 2 years, that track record can't be attributed to him. So it's a big problem in the mutual fund industry.
And who would even think, that's why I love this brochure, who would even think about looking up the manager to know that they're going to have an effective mutual fund moving forward? Paul, my next one's for you, and it's number 6, misleading ads and limited disclosures create confusion.
Yes, unfortunately they're misleading, but they're legal. So not a whole lot we can do about it except educate folks about it. One of the ways they do that, and one thing I always tell people about the mutual fund industry, they're geniuses at, and that's marketing. They're geniuses at marketing. And look at the catchy names of some of the funds if you think about it. Or they'll show you a graph with up arrows and smiley face or something of this nature, you know what I'm saying? Which kind of leads you to misconceive things a little bit. And the SEC requires that mutual funds name be implied by 80% in investments that imply their name. Well, like for example, the United States Income Fund, if you were to buy that, Mark, would you think that's pretty safe?
I would. Yes, I would.
You would think it's made up of mostly income-producing fixed assets, right?
Sure.
But they could be 20% in those investments, and they could be 80% in dividend-producing stocks, okay? Which we know is maybe income, not guaranteed income.
You know, it's another thing I love too, Paul, when they put conservative in the front of it.
Yeah.
The conservative something fund, you would think, okay, this isn't going to be a risky one for me. I can maybe put a couple extra dollars. You see where I'm going with that. So I agree with you. Sometimes those names are, in fact, not what they should be.
Here's another example I see all the time on television. I can't mention company names, but there's an ad on TV that says, so-and-so funds defeat 92% of the Lipper Analyticals. That sounds fabulous, doesn't it? Okay. But what are the Lipper Analyticals? Lipper Analyticals are people in your mutual fund's peer group, like they're all in growth stocks or they're all in mid-cap. That just means they beat 92% of the other funds. So in 2008, the Lipper Analyticals could have been minus 40%. You could have been minus 33 and beat 92% of all the other funds, right? So it's kind of misleading numbers and stats. And I believe human psychology knows that they will misinterpret that number.
You know, and talking about misinterpreting something. April, I know you see a lot of folks that think they have a bond, but they're in fact in a bond mutual fund. Is a bond mutual fund a bond?
No, and I'm glad you asked that question, Mark, because I have people that come in all the time saying, oh, I have a bunch of bonds. And I say, really, do you own bonds or do you have bond mutual funds? And we always try to clarify that. And sometimes they don't know. I have to look at their statement to answer. And, you know, a major difference is if you own a bond portfolio and you think it's relatively safe, a 10 or 20-year bonds, right? You know that if you hold that for 10 or 20 years, if the bond doesn't default, you get all your money back. Well, the closer you get to that end time period, the less sensitive your bonds are to interest rate increases. And we all know interest rate increases are coming at some time, right? Whereas when you have a bond mutual fund, it does not have a maturity date. So you don't have that knowledge that you're getting all your money back at the end of the time. Instead, they have kind of average yield to maturity. And another thing that's interesting is most people think that they're in a relatively safe portfolio if they own bond mutual funds. In fact, when we do our risk analysis, showing them how much potential loss they can have, most people don't believe it. And what they don't understand is that sometimes those bond mutual funds use leverage to increase the yield, which also does what? Increases the risk of the fund. So there are a lot of unknowns about bond mutual funds. So just make sure when you say you own bonds, do you know, is it a bond or is it a bond mutual fund?
April, Paul, thanks so much. And you definitely want to get this publication, Mutual Funds, the Good, the Bad, and the Fine Print. Just call the number on the screen. Stick around, got a lot of great stuff to come. You're watching Retirement Today with April Roberts, because you deserve better.
It's your retirement. How will you live it? How will you be remembered?
Will you be able to send me an invitation?
Will you be there for my ball games?
Will you teach me your values? You'll be able to play with me.
Oh, help me go to college. How will I remember you?
Have the retirement you dream about. AskAprilRoberts.com.
Having no clear retirement plan is a mistake I see a lot in my financial planning office when I meet with someone new. It is extremely rare that someone comes in and has a clearly defined income plan for his or her retirement. One way you will be able to get a clearly defined retirement income plan is to talk to an independent financial advisor who specializes in retirement planning. Not someone who is specialized in getting you to retirement, but someone who is dedicated to getting you through retirement. If you don't have a clear retirement plan, then be one of the first 5 callers and you will receive a free complete planning review. There is no obligation and no cost if you have at least $250,000 saved for retirement. Here's what you will receive: a free report to sort through your current advisor's cost, a tailored plan to guard your investments, tax analysis to reduce liability and increase cash flow, and a custom income plan to boost retirement. Plus, you'll receive a budget assessment to help manage your cash flow. So call now for your free, no obligation financial review.
You're watching Retirement Today with April Roberts, because you deserve better.
Let's talk about how to build your retirement income home. What am I talking about? We're talking about taking your retirement savings and building them in a way so that it creates a space you can move into and stay into in retirement. I'm guessing if you want to move into a home for the rest of your life, you want to make sure it's a sound home, right? So let's talk about how we do that for our clients. First, we like to start with their foundational assets because, as we all know, the foundation is the strongest part of the home. In fact, I learned this lesson in a tough way. I'm from South Mississippi, which most people know was devastated by Hurricane Katrina. I actually was there visiting my parents when Hurricane Katrina hit. 2 days later, 25 people were living in my parents' house due to the catastrophe. So to get away from everyone, my sister and I thought it was a great idea to put my 2 nieces, who were 5 and 6 at the time, in the back of my parents' Jeep Cherokee and drive down the beach as we knew it. When we got there, there was no beach, there was no road, there was nothing. It was kind of like a scene from that movie The Day After, and everywhere we looked, we saw nothing except for what? Foundations. So the important thing to know about foundations is no matter how bad the storm, the foundation always remains. So let's think back. In 2008, if you had a foundation, would you still have it? Yep. How about 2000? If you had a foundation back then, would you still have it? Absolutely. Remember, the foundation always remains. So for our clients, we like them to take their daily income from the foundation. The problem is most people don't know what foundational assets are. There are really 3 places you can go to get foundational assets. Number 1, the bank. Number 2, U.S. Treasuries, and number 3, a life insurance company. So we want to set something up that gives you a stream of income that, guess what, no matter what happens, it always remains. After we have your income in place, because that's extremely important, we're going to go to the walls of your house. And I like to have you think about the walls as your lower risk investments, right? Here we can dip a little bit. Anytime we're invested in managed accounts, we could lose some money, but we don't want to lose too much where it's not recoverable. So our lower risk assets that are yielding some income for us. And for my clients, I like to think of this as our fun money, right? If we need to, we take the yield off these investments and we golf more. We go on vacation, we spoil our grandkids, or we pay for their college. And then at the top, you have your roof. That's your high risk investments. And anybody who's been through a storm knows what's the first thing to go? Your roof, right? In fact, most people as they enter into retirement, they'd be okay with the nice flat roof on their house. They don't really want much in higher risk. But over time, it's good to have some because this is going to help us hedge against inflation, leave money behind to the kids, or to grow our assets for emergencies in the future. But we definitely want this to be our longer term investments because if we're in a downturn, do we want to touch the roof? No. That's why we want to set up your income from the foundation. We'll take our fund money from the walls because your walls might get crooked and need some patching, but they're not really going to fall down unless the storm's really bad. And then we'll leave the rest in the roof. So many people say, great, April, so all your clients' accounts look the same. They have foundation, walls, and roof. They do all have foundation, walls, and roof. However, everyone's plan does not look the same. Does your home look like your neighbor's? No. It depends on your needs. And guess what drives our need for income? Whatever amount you need to take from your home to provide income in retirement. Let's say that you get $5,000 a month between Social Security and pension, but you typically spend 7%, right? Well, $7,000. You need $2,000 a month. What we want to do is then take that number times 12 and divide it by the total amount you have saved. So let's say one household needs to take 3% from their retirement income home to supplement their income. If another household needs to take 6% from their retirement income home, do you think their 2 homes look the same? Probably not, right? That wouldn't be a sound retirement income home. So that's why when you come in, we always start with an income analysis because we want to fill your income gap from where? From the foundation. Then we're going to do a risk and fee analysis on your current portfolio so you understand how your home is built currently and how much you're paying for that home. And then finally, we're going to look at taxes because taxes, inflation, healthcare costs, they can all erode your retirement income home. So we want to look at all of these for your current scenario before we start to rebuild your home with us. So if you have any questions, please feel free to visit our website or give us a call at the office.
You're watching Retirement Today with April Roberts because you deserve better.
Life, a series of moments. A touch, a look, a laugh. Successful people. It might not be superior imagination. It just might be superior retirement planning. Imagine what's next. Plan today, own tomorrow.
Call Roberts Wealth Management, 713-322-6600.
You're watching Retirement Today with April Roberts, because you deserve better. Hi, and welcome to this week's Retirement True or False. I'm with Paul and April Roberts. And Paul, my first question is for you, and it is, most investors have read the prospectus that comes with their mutual funds. True or false?
I have to really think about that one, Mark. I think the answer is false. No, I'm joking. I'm playing with the audience here because that's almost a laughable question. 44 years in the business, I don't think I know 5 people that have ever read a prospectus, including me. Now, I do research to prospectuses and look and see what fees are in certain terms of a mutual fund or something, but as far as reading a prospectus from front to cover, I think it's pretty rare.
And April, it just seems to me like they've taken, in most of these, there's been significant effort in moving all the information around so that it's actually quite difficult to decipher. Is that a fair statement?
Yeah, the problem is, especially if you're looking at cost in the investment, you know, one may be on page 5, another one on page 60, another one on page 72. So it's pretty thick, and most people automatically, when they get things in the mail like that and they don't know what it is, what do? They toss it, they use it for fire paper, they line the bird cage, right? So they know that the readers aren't reading it.
April, my next question is for you, and that is, the stock market will stop being volatile after this year. True or false?
Mark, how'd you guess? It's going to be like
Here it
magic.
comes, here it
December
comes.
31st, all volatility stops.
Love it.
In fact, one thing that's annoying is that we even measure the stock market on an annual basis. Because do you think that the stock market knows it's December 31st or January 1st? Absolutely not. So in fact, I tell people you want to look at total drawdown of an investment, not the one-year return. Here's one example. From October 2007 to October 2007 to March 2009, the S&P 500 was down almost exactly 50%. But when you look at the historic numbers, it says that it was down 38% in 2008, and that's all anyone talks about. It's not the full story just because it was December 31st. So Mark, that's the nature of the market, to be volatile. I think we're going to continue to see volatility.
Paul, my next question is for you, and that is, all financial advisors are fiduciaries. True or false?
That's false. I don't know the exact percentages in the industry, but there are a lot more brokers than fiduciaries. A broker is subject to the suitability rule, which means if you can afford it, basically they can sell it to you. The fiduciary is subject to the prudent man rules, or you have to make decisions as a prudent man or do what's in your best interest. And you have to be able, it's not lip service, you have to be able to kind of document it in your files and be able to show you had that trend in your office.
And April, correct me if I'm wrong here, but the fiduciary also has to take different tests and get certified with different licenses. Is that correct?
Correct. A Series 65 is a fiduciary, whereas a Series 7 or 63 is a registered rep or a broker. So you're absolutely correct. And it's kind of funny because there's a lot of hullabaloo going on about trying to make all advisors fiduciaries. Well, I remember that Dad wouldn't let me even talk about anything until I had my license and I was a fiduciary. So, you know, that's a code of ethics that we live and die by.
April, my last question is for you, and it is, only 1/3 of retirees around the U.S. will have enough money to maintain their standard of living through retirement. True or false?
Mark, unfortunately that's true. Ernst & Young did a study that showed that about 1/3 of retirees, if they continue doing what they'll do and with the amount of assets they have, will be okay in retirement. So today, more than ever, retirees need to visit with someone, hopefully prior to retiring, so we can get a great plan in place. I love it when people come to me about 10 years before a retirement. That gives us plenty of time to help them. Sometimes they feel like there's not much we can do for them because maybe their 401k is tied up or other assets, but by starting to plan, we can often show them supplemental ways to save for retirement, and it's extremely useful.
April, Paul, thanks so much. Don't go anywhere. We'll be right back. You're watching Retirement Today with April Roberts, because you deserve better.
You're on the back nine heading for the clubhouse. Your dreams of spending time with family and enjoying retirement are just within reach. What happens if you end up in the rough? In these uncertain times, it's crucial to be prepared with sound advice. Roberts Wealth Management is one of the premier retirement income planning firms in Texas. For a complimentary consultation, call 713-322-6600. Roberts Wealth Management, helping you create a winning strategy.
Having no clear retirement plan is a mistake I see a lot in my financial planning office when I meet with someone new. It is extremely rare that someone comes in and has a clearly defined income plan for his or her retirement. One way you will be able to get a clearly defined retirement income plan is to talk to an independent financial advisor who specializes in retirement planning. Not someone who is specialized in getting you to retirement, but someone who is dedicated to getting you through retirement. If you don't have a clear retirement plan, then be one of the first 5 callers and you will receive a free complete planning review. There is no obligation and no cost if you have at least $250,000 saved for retirement. Here's what you will receive: a free report to sort through your current advisor's cost, a tailored plan to guard your investments, tax analysis to reduce liability and increase cash flow, and a custom income plan to boost retirement. Plus, you'll receive a budget assessment to help manage your cash flow. So call now for your free, no obligation financial review.
You're watching Retirement Today with April Roberts, because you deserve better. Thank you for joining us for another edition of AskAprilRoberts.com, where you, the general public, get to email in your question, and it gets answered here on the show, usually by April, but we've got a very special guest with us today, and it's Paul Roberts, the founder of Roberts Wealth. Thanks for being with us today.
Thank you very much. Good to be here.
Great to have you. And my first question is from Paul in Houston, and he writes, I've always believed that I should be debt-free once I'm retired. But with a 3.5% interest rate on my mortgage and a 0% interest rate on my car, I'm not in a big hurry to pay these things off before I retire. What are your thoughts on this?
First of all, Paul, I'd like to congratulate you on your name selection. Very good, very well done by your mom. But to do the debt thing, now let me just say this, qualify before we get started. In the financial world, there are no hard and fast rules that you hear all the time or you find in books, okay? But secondly, you don't have to be totally retired to retire. Actually, there's a 3-step review that we put you through in our office that basically covers cash flow or income planning. That's part of your income planning. So if you have a little bit of debt, you just need more income or cash flow, correct? So you can accumulate money for later in the past. I could see your point of why would I pay off a 3.5% loan? And we never thought we would live in this environment in my early days, so it was never addressed. Now it's addressed. But let me warn you, the cash flow planning or the income planning part of the 3-step process takes care of such matters when your cash flow changes.
Paul, thank you so much. And if you have questions that you'd like answered here on the show, just send them on in to AskAprilRoberts.com. Maybe April will answer them. Maybe we'll have the great fortune of having April's dad, Paul, with us. Thank you so much for being with us. Stick around. We got a lot of great stuff to come. You're watching Retirement Today with April Roberts, because you deserve better.
Remember when life was simpler? When things didn't move quite so fast, and the world didn't seem so complex? Remember that? We do. And as the world around us has continued to speed up, becoming more complicated, and still a bit uncertain, we have managed to keep things simple, providing sound, easy-to-understand financial advice and customized roadmaps for the road ahead, from tax reduction strategies, investment advice, and guaranteed retirement income you cannot outlive, backed by the claims-paying ability of insurance companies. We can be your single point of contact, a single call, a voice you recognize well, and a partner who can be by your side for the entire journey. We can't stop the world around us, but we can help ensure you're prepared for what's to come. To schedule a no-obligation meeting, simply contact us today.
You're watching Retirement Today with April Roberts, because you deserve better.
Thanks for watching the show today. If you have any questions, feel free to visit our website or give us a call at the office. And remember, a sound retirement income plan is your start to a happy and smart retirement.
It's your retirement. How will you live it? How will you be remembered?
Will you be able to take me on vacation?
Will you be there for my ball games?
Will you teach me your values? You'll be able to play with me.
Oh, help me go to college. How will I remember you?
Have the retirement you dream about. AskAprilRoberts.com.
Having no clear retirement plan is a mistake I see a lot in my financial planning office when I meet with someone new. It is extremely rare that someone comes in and has a clearly defined income plan for his or her retirement. One way you will be able to get a clearly defined retirement income plan is to talk to an independent financial advisor who specializes in retirement planning. Not someone who is specialized in getting you to retirement, but someone who is dedicated to getting you through retirement. If you don't have a clear retirement plan, then be one of the first 5 callers and you will receive a free complete planning review. There is no obligation and no cost if you have at least $250,000 saved for retirement. Here's what you will receive: a free report to sort through your current advisor's cost, a tailored plan to guard your investments, tax analysis to reduce liability and increase cash flow, and a custom income plan to boost retirement. Plus, you'll receive a budget assessment to help manage your cash flow. So call now for your free, no obligation financial review.